Listen carefully. What you are seeing in silver right now is not a simple price story, and if you interpret it that way, you are already behind. Most people look at a sharp move and assume strength. They see acceleration and think confirmation. They believe a rising price reflects a healthy trend, a stable signal, something they can follow safely. That is exactly how investors get caught at the wrong moment in a shifting system. I am not talking about a normal market environment. I am talking about a structure under pressure. Because when a critical asset like silver begins to move aggressively inside a system already strained by debt, distorted by policy, and dependent on fragile liquidity, the move is not just about opportunity. It is about stress building beneath the surface. You need to understand what is happening. Fast price movement in a fragile system is rarely driven by confidence alone. It is often driven by urgency. It reflects decisions being made by participants who are not reacting to headlines, but to underlying constraints. And those constraints are not always visible until it is too late. This is where most investors fail. They focus on what is visible. They react to charts, momentum, and sentiment. But serious capital does not operate that way. It studies pressure points. It studies behavior beneath the surface. It asks why capital is moving, not just where it is moving. And right now, the behavior around silver is not casual. It is not random. It is not isolated. This is not speculation. This is structure. Silver does not move independently, especially not in a late-stage debt cycle where the entire financial system is stretched. We are operating in a world built on leverage, sustained by refinancing, and stabilized by the assumption that liquidity will always be available when needed. That assumption has held for a long time, but history shows it does not hold indefinitely. And when that assumption begins to weaken, capital starts behaving differently. I want you to think about this clearly. When I see silver moving with this kind of intensity, I do not immediately think about profit. I think about pressure. I think about what is forcing large participants to reposition. I think about whether confidence is beginning to crack in areas that have not yet reached public awareness. Because by the time it becomes obvious, the adjustment is already underway. Now place China into this equation. China is not a passive player. It is one of the most influential forces in global industrial demand. Its decisions ripple through supply chains, pricing mechanisms, and strategic resource allocation across the world. When China begins to shift its behavior around a material like silver, you should not ignore it. You should study it, because countries do not move aggressively toward critical materials without reason. They do not increase focus, adjust procurement, or alter positioning unless they see something changing ahead. This is where the situation becomes more serious. If China is becoming more deliberate around silver, whether through stronger industrial demand, more consistent accumulation, or a strategic shift in how it views supply, then the implication is not limited to one market. It suggests tightening conditions. It suggests that availability may not be as flexible as it appears. It suggests that future access could become more competitive. And when that realization begins to spread, the market does not adjust slowly. It reprices. You have to understand the difference between paper perception and physical reality. Financial markets can suppress signals for a period of time. They can create the illusion of balance through leverage and liquidity. But eventually, physical demand forces truth into the system. When real buyers need real supply, assumptions get tested. And when those assumptions break, adjustments happen faster than most investors expect. The real question is not whether silver will continue to move. Volatility is normal. That is not the issue. The issue is whether the underlying structure is changing, whether the balance between supply and demand is shifting in a way that cannot be easily reversed. Are inventories becoming tighter? Are large buyers acting earlier and more aggressively? Are procurement strategies becoming more defensive? These are the questions that matter. Because once enough of these signals begin aligning, the system transitions from stability to pressure. And once that transition begins, price no longer reflects comfort. It reflects constraint. This is where most people hesitate. They look for confirmation. They wait for clarity. They want the narrative to become obvious before they act. But clarity comes late, and late is expensive. Serious investors understand this. They do not wait for headlines to confirm what structure is already revealing. They study behavior early. They recognize patterns forming beneath the surface. And when those patterns begin to align, they do not ignore them, they prepare. Because this never resolves quietly. When pressure builds in a system with limited flexibility, the adjustment does not come through smooth expansion. Supply cannot respond instantly. Production takes time, infrastructure takes time, capital deployment takes time, political processes take time, everything takes time. And when demand begins strengthening against that slow response, the system has only one efficient mechanism left to restore balance: price. Now think about what that means if China is positioning itself more aggressively within this environment. If it sees future constraints, if it understands that waiting could become more costly than acting, then the signal is already in motion. And the real question you need to ask yourself is simple. Are you reacting to pricey? Or are you understanding the shift before the system forces everyone else to see it? I want you to go deeper, because this is where the real implications begin to emerge. You cannot analyze silver in isolation and expect to understand what is unfolding. You have to step back and examine the larger system in which it operates. Because commodities do not exist outside of macro conditions. They are shaped by them. We are late in a debt-heavy cycle. That is not an opinion. That is a structural reality. Governments are carrying obligations that are increasingly difficult to manage without intervention. Fiscal deficits are not shrinking. They are persistent. And central banks are being asked to maintain stability in an environment where inflation pressures have not fully disappeared. This creates tension, because highly indebted systems do not tolerate tight conditions for long. When interest rates remain elevated, the cost of maintaining the system rises. Refinancing becomes more difficult, growth begins to weaken, asset prices come under pressure, and eventually something breaks. This is not a theory. History has shown this pattern repeatedly. The real question is not if the system will respond. The question is how, because when pressure builds to a certain level, policy shifts. It always does, whether through direct easing, indirect support, or the quiet acceptance of higher inflation, the system adjusts. It has to. The alternative is instability that becomes politically unacceptable. And when that adjustment begins, the signal to capital becomes clear. Financial assets, particularly those dependent on stable currency value, begin to lose certainty in real terms. The purchasing power behind them becomes less reliable. And at that point, tangible assets begin to matter more. This is where silver becomes critical. Gold is the traditional monetary hedge. It has a long history of absorbing distrust when currencies weaken. But silver operates differently. It is influenced by two powerful forces at the same time. It responds to monetary instability, and it responds to industrial demand. When both of those forces activate simultaneously, the pressure does not simply add. It multiplies. Think about that carefully. If monetary conditions are pushing investors toward tangible assets, that alone creates demand. But if industrial systems are also pulling from the same supply base, then the competition for that supply intensifies. And when a major industrial power like China is involved in that competition, the dynamic becomes even more pronounced. This is not a normal environment. This is a convergence, and convergence changes outcomes. Now consider the broader implications. If China is increasing its focus on silver while the global financial system remains under strain, then silver is no longer just a commodity. It begins to function as a strategic asset inside a stressed system. That changes how you should think about it. It changes your time horizon. It changes your expectations. And most importantly, it changes how you assess risk. Because the risk is not simply volatility. The risk is misinterpreting the environment. Most investors still operate with outdated frameworks. They separate industrial metals from monetary metals as if those categories are fixed. They treat inflation, growth, and policy as independent variables. They assume that markets will behave in clean, predictable ways. But real transitions do not work like that. They blur boundaries. They merge forces. They create conditions where a single asset can reflect multiple layers of stress at the same time. Silver is one of the clearest examples of this. It can rise because of industrial demand. It can rise because of monetary instability. And when both drivers are active together, the move becomes more complex, more powerful, and more difficult for traditional analysis to capture. This is why you need to pay attention now, because once the narrative becomes simple, the opportunity has already changed. You also need to understand how confidence erodes. It does not collapse all at once. It weakens gradually. It fades at the margins before it breaks in more visible ways. Currencies do not lose trust overnight. Purchasing power declines slowly at first. Institutions adjust their exposure carefully. Governments respond incrementally. Investors begin questioning assumptions they once accepted without hesitation. This is how structural change begins, quietly, then progressively, then suddenly. And by the time it becomes obvious, positioning has already shifted. This is why structure matters more than noise. Daily price movement does not tell you where the system is heading. Incentives do. Ask yourself what incentives are forming right now. If governments are incentivized to manage debt through policies that tolerate inflation, that matters. If central banks are constrained in their ability to maintain tight conditions, that matters. If supply chains are being redesigned for resilience rather than efficiency, that matters. If strategic materials are being prioritized at a national level, that matters. All of these forces are connected, and they all point in the same direction. A system that is becoming less stable, less efficient, and more dependent on real assets. That is the environment where silver takes on a different role. It is no longer just something you trade. It becomes something you monitor as a signal, because it reflects multiple pressures at once: monetary strain, industrial competition, supply constraints, strategic behavior. And when those pressures begin aligning, the signal becomes difficult to ignore. This is where serious investors separate themselves from the crowd. They do not wait for consensus. They do not rely on simplified narratives. They do not assume that stability will continue just because it has in the past. They study shifts early. They observe behavior. They recognize when incentives begin to change, and when those changes point toward tightening conditions and rising strategic importance. They do not dismiss it as temporary. They take it seriously. Because once the system starts adjusting, it does not ask for permission. It moves. And when it moves, it does not wait for everyone to be ready. The only question is whether you are paying attention before that movement becomes undeniable. Now I want to bring this into focus, because this is where most investors lose clarity. They start to see the signals, but they do not follow them to their logical conclusion. They hesitate. They second guess. They tell themselves the system will stabilize the way it always has. But you need to be very careful with that assumption, because the system you are dealing with today is not the same system that existed in prior cycles. The level of debt is higher. The margin for policy error is smaller. The dependence on continued intervention is greater. And the global environment is more fragmented, more competitive, and less cooperative than it has been in decades. That changes the outcome. I am not talking about a minor correction. I am talking about a potential shift in how capital behaves under pressure. Because when systems reach this level of saturation, they do not return to equilibrium easily. They transition, and transitions create dislocation. You can already see the early signs if you are paying attention. Strategic materials are being treated differently. Supply chains are being restructured. Nations are prioritizing access over efficiency, and capital is beginning to respond to those changes even if the broader narrative has not caught up yet. Silver sits directly inside that shift. It is not on the edge of this story. It is at the center of it. because it connects industrial necessity with monetary reality. It reflects what happens when production systems require more of a resource at the same time that financial systems begin to question the stability of currency and credit. That is a powerful combination, and it is not something that resolves quietly. I want you to think about how markets actually adjust under these conditions. They do not move in a straight line. They move in phases. There are periods of acceleration followed by pauses. There are pullbacks that create the illusion of stability. There are moments where sentiment resets and participants convince themselves the pressure has passed. But if the underlying structure continues tightening, those pauses are temporary. They are not resolution. They are part of the process. This is why focusing only on short-term movement is dangerous. It distracts you from the larger shift. It pulls your attention toward noise instead of structure. And in doing so, it keeps you reacting instead of preparing. The real work is not in predicting the next move. It is in understanding the direction of pressure. Ask yourself again, what is actually changing? Are inventories becoming less comfortable? Are industrial users acting with more urgency? Are governments and large institutions treating silver with greater strategic importance? Are the conditions that support easy supply expansion becoming more constrained? If the answer to those questions continues to lean in one direction, then the system is already adjusting, and once adjustment begins, it does not reverse easily. This is where the concept of inevitability becomes important. Not inevitability in timing, but inevitability in direction. Because when enough structural forces align, the outcome becomes increasingly difficult to avoid. History has shown this repeatedly. When supply is slow to respond and demand becomes more urgent, price absorbs the imbalance. When monetary confidence weakens and tangible assets become more attractive, capital reallocates. When large players act early, smaller participants are forced to react later. This is how cycles unfold, and this is why the distinction between smart money and the average investor becomes so clear in moments like this. Smart money does not wait for perfect clarity. It does not need every variable to be confirmed. It operates on probability, on structure, on incentives that are already forming. It understands that by the time everything is obvious, the opportunity has already changed. The average investor, on the other hand, looks for reassurance. They want validation from price, from media, from consensus. But consensus is slow, and by the time it arrives, it is often reacting to a move that has already begun. That delay is costly, because markets do not reward late understanding. They reward early recognition. Now bring this back to China's role in all of this. If China is positioning itself more aggressively around silver, it is not doing so randomly. It is responding to incentives. It is anticipating conditions. It is acting based on a forward view of supply, demand, and strategic necessity. And when a player of that size begins to move with intention, you should not ignore it. You should ask why. Because the answer to that question often reveals what the broader market has not yet priced in. This is not about reacting emotionally. It is not about chasing a move. It is about recognizing a shift in behavior and understanding what that shift implies over time. If silver is moving from being treated as an abundant input to being treated as a constrained and strategic resource, that has consequences. It changes how supply is valued. It changes how demand behaves. And ultimately, it changes how price adjusts to reflect those realities. Most people will not see this clearly until later. They will interpret each move in isolation. They will look for short-term explanations. They will underestimate the significance of what is building beneath the surface. But you do not have to. You can choose to look deeper. You can choose to understand the structure instead of reacting to the noise. Because once the system fully reflects these pressures, the adjustment will not ask whether you are ready. It will already be happening. And at that point, the only thing that will matter is whether you recognize the shift early enough to position yourself before the rest of the market was forced to see it.